10-year yield just hit the 99th percentile, and the 10-year at this level reprices every leveraged asset in the economy. Something is breaking beneath the surface and the data confirms it. Right now, 10-year yield is at 4.47%, the 99th percentile for the past year. Historically, the 10-year at this level reprices every leveraged asset in the economy. The volatility expert says the VIX term structure is warning of a volatility event. The data says the MOVE index rose 14.7% today, moving against the bearish consensus. In the next few minutes, I will show you who the data says is right and what it means for your money this month. The scoreboard just changed. A scoreboard flip means the numbers shifted. Pay attention to what moved and why. The commodity analyst called it commodity supercycle. Oil at $102.2 confirms it. 149-day streak, the volatility expert called it volatility expansion. VIX at 17.3 confirms it. 6 days running, McElroy might be right, but the data has not confirmed the thesis yet. 148-day streak. Too early to call Hartman right or wrong. The thesis is building but not confirmed. 142-day streak, the dollar analyst just moved from right to early. Too early to call the dollar analyst right or wrong. The thesis is building but not confirmed. Bad stretch for Gammon, for now. Yield curve at 0.50% says the opposite of credit will blow out. 3 days running, Snyder's call is not working, for now. Yield curve moving against the bearish thesis, up 6.4%. 3 days running, score today, 2 right, 3 early, 2 wrong. A scoreboard flip means the numbers shifted. Pay attention to what moved and why. Today's big question, is a volatility event coming, or is the VIX lying? The volatility expert says the VIX term structure is warning of a volatility event. That is the thesis driving the debate today. It sounds right on the podcast, and it is a clean narrative. But here's the problem. The MOVE index rose 14.7% today, moving against the bearish consensus. If the data is right and the speaker is wrong, positioning changes fast. Here's what makes this interesting. VIX is falling while the MOVE index is rising. Those two signals should not be going in opposite directions. When they diverge like this, one of them is lying, and the resolution is usually fast. VIX at 17.3 65th percentile, down 3.4% today. The MOVE index at 79.9 61st percentile, up 14.7% today. Bottom line, the data is pushing back against the volatility expert. Until the signals confirm, the thesis is early. If VIX breaks above 35, that confirms the volatility expansion thesis. Right now, it is at 17.3. If the MOVE index drops below 100 while VIX stays elevated, it is equity-specific risk, not systemic. VIX at 17.3, we'll track it daily on the scoreboard. The MOVE index at 79.9, we'll track it daily on the scoreboard. None of the 7 are talking about this next signal, and they should be. High-yield spread just dropped 2.1% to 276 basis points. A move this size demands attention. Historically, high-yield stress at this level signals institutional risk aversion building. None of the 7 are talking about this. Keep it on your radar. Phase 1 is the good times, but good times do not last forever. Here is how close we are to the edge. We are 74 basis points away from Phase 2, the phase where credit breaks and volatility spikes. There is no acceleration in credit stress yet, but we are watching the pace, not just the level. The trigger, investment-grade spread crossing 150 basis points. Currently at 76 basis points. Pace is flat or improving, no urgency right now. Phase 1 means risk on is working. Equities, commodities, and real estate all benefit from loose conditions. Enjoy it while it lasts. For context, the last time credit stress built like this, credit spreads blew out and high-yield bonds saw drawdowns of 15%. The credit and rates layer has initial jobless claims, copper-gold ratio, flashing red. Gammon says, the Fed is breaking things, and credit spreads will blow out. The data disagrees with that thesis right now. Phase 1 holds with 74 basis points of buffer. Conditions favor risk, but do not get complacent. Wall Street trades the index. We trade the ground. Here is what the ZIP level data is screaming about today. VA, days on market, is collapsing in Virginia Beach. Days on market in Virginia Beach moved 100% in 30 days, now 8 days. Buyer leverage score, 47-100. Days on market is the cleanest leading indicator we have. Big swings mean liquidity is changing fast. LA, days on market is spiking in Homa. Days on market in Homa moved plus 100% in 30 days, now 248 days. Buyer leverage score, 5100. Days on market is the cleanest leading indicator we have. Big swings mean liquidity is changing fast. Beaufort County, SC, payment burden is past the breaking point. Sheldon, SC, median home about $2,321,000 on about $117,000 household income. Price-to-income ratio, 19.9. When the math stops working, sellers find out before buyers do. These are not hand-picked metros. They are the loudest signals in the housing data right now, chosen by the numbers, not the narrative. Today's debate asked, is a volatility event coming, or is the VIX lying? Let me show you what happened the last time we were here. VIX at 17.3, the 65th percentile. Notable but not extreme. In 2022, bonds and tech both broke and the 60-40 portfolio had its worst year in decades. In 2020, the fastest bear market in history at 34% in 23 trading days. In 2018, markets dropped 20% in 3 months, and the Fed was forced to pause. Different environments, different catalysts, but every time, the resolution came fast. The pattern is not the level, it is the speed of the move once it starts. Meanwhile, the MOVE index at 79.9 is in the 61st percentile. The last time both VIX and the MOVE index were at these levels simultaneously, the resolution came within weeks. That is why the scoreboard matters. It tells you which speakers saw it coming and which ones missed it. If history rhymes, the volatility expert should be paying close attention because the clock is ticking on this pattern. Here's what the data says to do right now. Stay alert on VIX. It is dropping 3.4% today. Fast moves demand attention. Avoid Phoenix at 41% payment burden, that is stretched territory. Watch high yield spread. It dropped 2.1% and nobody is talking about it. Every signal is live at analyze.builderslens.com. The podcasters give you the thesis. We give you the scoreboard. Subscribe and I will see you tomorrow morning.